Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, Jim, I always look forward to our getting together with our listeners on Fridays, and it's been a fascinating market out there.
And as usual, we love to answer listener questions. We have several today, so let's just wade right into them. The first question, on the 15th of September 2019, an unsuccessful drone attack on a Saudi refinery marked an interim top in the oil price. It was followed by the assassination of an Iranian general in early 2020. That was a drone strike ordered by President Trump. Yep. Should Middle Eastern political persons make preparations to meet their maker in the coming 3 to 4 months following another drone attack on March 7th this year on a Saudi refinery, which also marked a recent top in the price of oil? So, should they be listening for the drone of drones?
Yeah. Hey, that's good conspiracy stuff. Good eye in catching the timing on those events. And all I can say is that from time to time when crude oil prices might be uncomfortably weak for the system, somebody will engineer something in the Middle East. But the premium for Middle East risk is diminished substantially since 2014. But with the Biden administration out to shut down American oil and gas reserves and exploration and expansion wherever they can, it's going to place more power back in the hands of Middle East crazies, won't it? So, yeah, always elusive stuff in the Middle East.
Yes, we should point out, too, Saudi Arabia supplies, I think, about 1 million barrels of oil to the U.S. a day. Canada, by far, is the biggest foreign supplier of oil to the U.S., somewhere between 3 and 4 million barrels of oil a day. So, unless you start seeing those little streaks of contrails above our leaders, I don't think the Americans really should worry about their supply of oil. Canada's got lots.
Yeah, but the Biden administration doesn't like pipelines either. So
no, they don't.
Nope, they want to have all the oil delivered, all the petroleum products delivered by trucks and railroad tankers. Just lovely ideas. So.
And tankers from the Middle East. Our next question from Michael. Jim and Bob, I have 2 questions for Bob. Michael always likes to get a bargain from us. His first question, even with rising long-term interest rates, this market is still making all-time highs. The NASDAQ is the only market not making a new high. Bob, is this the sign of a top in the NASDAQ, or maybe for all the markets?
Yeah, I think you've got rising long rates because the fear of inflation is back. And that's just long treasury yields that are going up. But if real inflation was coming back, the 1970s type, short rates would be like T-bills would be soaring as well, and they're not. But the bonds that trade like stocks, junk bonds, they've been doing well. And of course, with treasuries doing poor, the credit spreads have had a fabulous move. And up to technical excesses, and are poised for reversing. This will this one will get the stock market on as this credit spreads reverse and turn to widening. It sure worked in 2007, but in that year we were looking for the reversal in the yield curve and credit spreads to occur in May to June of 2007, and the curve turned first, and then in June spreads widened, so it worked very well. This one, the yield curve became signaling danger on the reversal in December and January, but it wasn't accompanied by the equivalent reversal in credit spreads. So here we are. But now I think we're poised for spreads to change, and this will be a dampener on all kinds of speculations.
The second part of the question from Michael, rather lengthy. The debate rages in regard to deflation versus inflation going forward. Some say first deflation, then rampant inflation. It seems that the inflation camp see this as a tailwind to unstoppable rising equity valuations. Bob, how can we ever have inflation with so much debt, declining populations, overcapacity, robotics, automation, and tapped-out consumers? And then a few analysts talk about stagflation. He remembers that was a term coined back in the 70s when nobody's income was going up that much, but prices sure were.
Yep.
Bob, how can all this play out this year and into next year?
Well, I don't think it will. The inflation bugs learned their stuff from 1970s when the Fed was reckless, and but the public chose then to speculate in tangible assets, commodities, wages, all kinds of things. So it was the classic inflation, and it worked its way out. Now, in the past, when you had a decade of rampant such inflation, gets overdone and crashes. You know, for example, in 1920, the rate of CPI inflation got up to, I think it was 24%, let's say 22%, and then within a year, it was minus 16%. So it was a crash of biblical proportions, and then that set up a decade of speculation in financial assets called the Roaring Twenties. So, and this pattern goes back to the first great bubble, the South Sea bubble in 1720. And the pattern is a decade of speculation in tangible assets in the old-fashioned inflation, and then you then come along a decade of inflation in financial assets. And those who are fully up on 1970s inflation can't understand that bond prices have been highly inflated. And then the pattern is that the public chooses. The Fed is just as reckless as it was during the commodities boom, but commodities firm. But the big boom has been in financial assets. It's a great financial bubble. So that's very straightforward. History now suggests that when this bubble fails, and it could fail, it could be discovered to be failing in the fall, then you go into hard deflation of most financial assets. So that's the pattern, and those who are now calling for 1970s type inflation haven't done enough research. I think if they did the research into history, you just couldn't make that statement. History suggests that when this financial bubble is over, everything goes down except for the price of gold.
A question from Bentley Wade. Hi, I'm not sure if Bob subscribes to any conspiracies, but nonetheless, I have a conspiracy question for him. If there are international groups who wish to reset the global economy, wouldn't the surest way to do that be through a massive global deflation, thus making debt unpayable and forcing people to liquidate their leveraged homes and assets? I'd be interested in Bob's opinion.
Hey, that's good. I always love conspiracies. But this one, no, I think it suggested the answer in the last question is that no ambitious government is ever going to wish for a deflation. As a matter of fact, the whole of government is geared to keep prices up and inflation going and central bank operations and all that sort of stuff, because it does. Interventionist central banking does transfer huge amounts of wealth and prestige to the state, as long as it's working. So, no, they are not planning to use deflation as any sort of advantage for big government. Big governments have always resorted to inflation and currency depreciation when taxes are not can't fund. I know, that reminds me of a Mises phrase, which was, if governments can obtain all the money they need from the printing press, then taxation exists only to confiscate wealth. God, I'm going to write that one down. I like it.
Yeah.
But the worst thing that can happen for ambitious government is an old-fashioned type of deflation, which I believe is coming, could be discovered by the fall.
China's solution to their debt is just to print money to pay it, because friends of mine who work in China say their monthly tax on whatever salary they make is $8 a month. So obviously China doesn't have interest in taxation. They plan to print their way out of debt. Bob, how would that scenario end up? Of course, they'd have their own banking system, their own closed society. They're different than any other creature on the planet. How do you think it's going to end?
Same way. That massive crash of the 1920 commodity bubble, it hit Russia as well, and they turned from full-on communism to some sort of a BS type of socialism. In the United States, with that change and the crash, before 1920, can you believe it? The U.S. government was nationalizing railroads, absolutely unthinkable. And then with the change in politics in 1921, they began privatizing railroads. And then in the 1929 boom, that was John Moody, Moody himself, in an essay wrote, he pointed out that one of the reasons why that boom would continue forever was because so many governments were getting away from socialism, and you were forming any numbers of retail consumers. So you get the change of politics, too. So, I always like these conspiracy questions, but I think we're just going to get just plain old-fashioned post-bubble deflation.
Bob, one of the reasons I question so many conspiracy theories is, from the politicians I know, they couldn't organize a parade in a one-car town.
You're right. Mm-hmm.
Justin from Berkeley, I believe. Or that was, yes, Justin from Berkeley has a question here. 2 very important questions according to him. First, since 1970s inflation gave Wall Street PTSD, what were the conditions to cause that level of interest rates?
Yeah. Well, that one's fascinating, Justin, because you had a secular low in long-dated interest rates in 1946 at about 2.5%. Then rates started to rise because the world started on a long economic expansion, and the U.S. government was carrying huge debt for prosecuting World War II. So it became simple arithmetic. At 2.5%, the debt service costs were that much. At 3%, it was that much more. So the powers that be decided that they were going to prevent rates from rising. So the Fed started buying bonds out of the market. And they bought bonds out of the market, and then in the mid-1960s, the long rate got up to 5%, and then in the 60s got up to 5%, and then they got even more ambitious because their theory wasn't working, so they thought they'd try twice as hard. and they called it Operation Twist, where they were buying the long end and doing whatever. And so the very effort to lower rates by buying bonds out of the market was injecting so much cash into the markets that the dollar started to depreciate. So then you have the function coming in, the discount for inflation. So the nominal rate went up to 14%. In Canada, the long bond went up to 19%. And in 300 years of history prior, the highest in the senior country and senior financial market was 6.5%. So, I mean, this was extraordinary stuff. So the very effort that these idiots were doing to bring rates down were raising rates to an unprecedented level. So here now, more recently, on the subject of interest rates, again, the same idiots with theories that don't work. Part of the theory of pushing money out the window is that it then stimulates the economy. But when it's time for the public to speculate in financial assets, it goes into financial asset speculation. This is how then you've ended up in Germany with the 10-year note at minus 0.8%. Nominal. Never happened before. So I want to tell you that policymakers and the economists, the academic economists who cater to bureaucrats, policymakers, and government are absolutely all mad and haven't got a clue what they're doing, but still are able to impose strange theories upon the market rates. So anyways, the inflation now is in financial assets. There has been rallies in industrial commodities, base metals, copper, crude oil, lumber has been outstanding, and these now are all overbought. And so I think all the inflation that's going to come in of the old kind of inflation is in the market now. So, and then we've got the question is what would cause the level interest rates? Well, what we're going to get here, quite likely, is a decline in the T-bill rate. The rise in long rate treasuries is about as far as it's going to go, but you're going to get a hell of a crash in lower grade corporate bonds and municipals and all that sort of stuff. So we're looking for price deflation in financial assets.
Secondly, from Justin in Berkeley, he says, you two were discussing Sean Connery a while back. Can Bob give us the definitive answer as to who is the best James Bond so we can lay that question to rest forever? May Scotland live forever.
Justin, thanks for that one. It's really good. I looked at the question earlier and I thought, well, which one? And I liked the Timothy Dalton, British actor, as Bond in two films in the 80s. One of them slipped my, To Live and Let Live or something like that. One where
Roger Moore.
Wrong one. But anyways, the Timothy Dalton ones, one of them occurred in Europe and they had this wonderful scene where he and the lovely young lady are sliding down a snowy hill in the case for a double bass cello or something like that. So, no, I think Dalton, he did two of the James Bond movie, and other than Sean Connery, who set the genre, I like the Timothy Dalton ones.
I think the best opening to a Bond movie had Roger Moore skiing down a hill, goes over a cliff, and his parachute opens, and it's a Union Jack. Well, Carly Simon sang Nobody Does It Better, but my favorite Bond song has to be Live and Let Die by Paul McCartney, mostly because I'm a die-hard Paul McCartney fan.
Yeah. Oh, no, they've been a great source of entertainment, the Bond series, so, yeah.
And Ian Fleming really was a spy.
Yep.
He was intrepid. And the Dieppe raid that was a disaster for Canadian troops. It's only been revealed in the last year or two that the real mission of that wasn't to practice for D-Day, but to steal an Enigma machine, the German coding machine, that they thought was uncrackable. Yep. But the Poles actually, before the war even started, had started to crack that code. And then when the Polish spy masters fled to England together at Bletchley Park, they cracked the code and the Germans had no idea. Wow. So you talk about conspiracies, Bob. Bob, talk about conspiracies. There's the real deal.
Yeah. Well, they had to get a new variation of the Enigma machine that had 4 wheels instead of 3 wheels or something like that. But at any rate, Ian Fleming, the novelist, was also, as you said, in Secret Service with the Brits, and he was also from a very wealthy family. So can you imagine being a good-looking guy, all the money in the world, working in the Secret Service? Well, God, what a life. Would have been great.
Well, if he had money, he could have been Batman.
It could have been anything you want, but that was Fleming family funds. It goes back to the grandfather, and it was kind of like a merchant bank out of London. And the last I knew about Fleming family funds, they were managing about 15 billion pounds. So, yeah.
Oh, what you and I spend on lunch every day.
Sure.
We'll have more with Bob Hoye next.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, some interesting headlines you came across. The first one, COMEX trend silver short squeeze is on track. That means we're going to see, I guess, another attempt to either boost the price of silver or take advantage of the current price.
Yeah, they're still trying to talk up silver, but no, you're not going to get a runaway market in silver, although the chronic silver bulls every year look at supply demand and say, this is the year that silver's going to go to the moon, but it never happens.
Fred, the Fed promises not to take away the punch bowl. What does that mean?
Oh, yeah. Well, the quip has been is that just when the party gets really going, the Fed takes away the punch bowl. And that's a way back in archaic times when, as short rates went up during a boom, the Fed had to follow and raise their administered rate. And the old saying was you'd get 3 rate hikes by the Fed, and then the bear market would start. So, because the Fed doesn't do that anymore, but it was, 3 stumbles and a fall or something like that. But anyways, in the old days, the Fed would raise rates following the market up, and but so no, they don't take away the punch bowl. They keep filling the punch bowl, and then as somebody said a decade or so ago, that when the Fed is filling the punch bowl, everybody drinks until they fall down. So either way, it's all going to go to hell at some time anyways.
Another headline, this one from Bloomberg. Dear market, don't worry, be happy, the Fed.
Yeah, yours, the Fed. Yeah, I've been collecting headlines out of, like, various places, The Economist and Wall Street Journal and Barron's going back for hundreds of years, where you then have sort of specific statements on great market events going way back. So, and this one, I'm telling you, this one, dear market, don't worry, be happy, that's a collector's item. It's absolutely wonderful.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Headline: Penny stocks booming. Good news for swindlers.
Yeah. I hadn't had time to find it, but I know that in my notes from The Economist in the 1870s, there is a bit of an editorial that, unlike any other market item, whether it's commodities or goods or services, it's the stock market that lends itself to fabulous promotions and swindlers and crooks and everything else. And I intend to find that one and match it up with this one about this, because as I said, this is classic stuff. That it's good news for swindlers. Yep. Because in a rising market, and here's one that I crafted years ago, and based upon experience here in watching the Vancouver Stock Exchange, is that so long as the price of the stock is going up, the people will believe the most preposterous story, and then when it turns and fails, then all of a sudden you've got recrimination and dismay and all that sort of thing that goes with it. But so long as the price is going up, the belief is incredible.
Another headline that caught our eye: J.P. Morgan predicts small and mid caps will outperform the senior markets not just now, but for decades. Why would they say that?
Oh, well, they have, research department has meetings, and then they got to come up with a theme, and then they'll make a major report on it. Now, this is obviously a major report, and this is called tangential extrapolation, whereby whatever is going on now, it will continue into the foreseeable future. And so this is sales product. This is meant to generate business and keep all the brokers happy and keep all the customers buying stocks. But the small caps were likely to outperform from our work in October, and they really have, but they have become now excessive. So, no, you have to monitor the market for excesses, technical excesses where you have measures to determine the degree of speculation, and then the other is a measure of a degree of speculation or headlines like this one from Morgan about small caps going to outperform for decades. Boy, this is a keeper, another keeper headline.
Well, I remember, I think in 1965, the head of IBM said, I don't see any need for more than 4 or 5 computers in the world.
Yep. That's a classic one. Yeah.
Yes, it is. Bob, thank you so much for being on the show.
Well, we did it again, Jim, and I look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob and he loves to answer them, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.